Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, let's just dive right in. We have to talk about the structural metamorphosis of Walmart, WMT. It's achieved a valuation that frankly was unthinkable for a consumer defensive stock even a few years ago.
Completely unthinkable.
The trajectory has just been relentless, really fueled by this intense momentum leading up to its NASDAQ 100 inclusion. I mean, the PE ratio now comfortably exceeds 40x. That's almost double the sector average. And to really get the gravity of this, you have to look at the price action right before. In late December 2025, huge insider blocks, I'm talking one instance of over 850,000 shares, were sold off by the Walton family trusts. The price was between, $114 and $116. And instead of that massive volume capping the price, the stock just absorbed it. It absorbed it and kept climbing toward 120. I mean, that is the definition of structural demand.
And that demand is exactly what makes this whole situation so precarious. It's what I'd call the paradox of the perfect price. You have this massive retailer trading at 40 times earnings, a multiple you'd usually reserve for a company growing revenue at, 25–30%.
Right, a tech company.
Exactly. But Walmart's core operation is still grinding out low single-digit revenue growth. We're talking in the neighborhood of 4 to 5%. So the market is claiming this fundamental identity shift has happened, but mathematically, 80% or more of that revenue still comes from selling low-margin stuff. It's an exceptionally fragile equilibrium. So the question for us is pretty stark. Is this radical valuation justified by a real transformation into a tech-powered omni-channel ecosystem, or is this stock just dangerously priced for perfection?
Well, I'd argue the market is acting rationally here. It's just executing maybe a delayed re-rating. We're finally seeing the payoff from this decade-long strategic pivot that the outgoing CEO Doug McMillon orchestrated. Walmart isn't just a grocer anymore. It's a technology deployer that happens to own the most powerful physical logistics network in the country. The key evidence for this premium is the success and scale of Walmart Connect, their ad arm.
Okay.
Connect is a seriously high-margin business. We're talking 70% plus margins, and it's scaling rapidly, 20 to 30% year over year. When you blend the business with that kind of high-quality, capital-light growth into the core retail structure, you fundamentally change the quality of the overall earnings. It justifies applying a tech multiple to the whole thing. And then there's the logistics moat. Their 4,600 plus US stores are basically forward-deployed distribution hubs. That gives them a last-mile advantage that even Amazon struggles to replicate in the grocery space.
The pivot is impressive. I mean, McMillon's legacy is undeniable, absolutely. But I challenge the premise that this shift in earnings quality justifies the scale of this PE expansion. Look, the valuation just caps. It fundamentally violates the traditional tenets of value investing, regardless of Connect's margins. A 40x PE is relying entirely on narrative, on technical flows, not the underlying operational growth you'd need to close that valuation gap in any reasonable time. The sheer size of the low-margin business means Connect would have to grow, exponentially faster for much longer than anyone is projecting just to keep this 40x multiple anchored. The moment sentiment shifts, the second analysts decide Walmart is a staple again, not a tech stock, the math suggests a violent correction. A reversion to, say, a 25x multiple, which is still a big premium, would mean a swift 30% drop. It's a house of cards built on faith and future execution.
I see why you characterize it as fragile, but let me introduce the structural element that makes shorting this stock, highly risky. It's almost financially prohibitive. We have to talk about the powerful technical floor under the share price, and this is independent of near-term performance. The Walton family still controls somewhere between 44.5% to 46% of the total outstanding shares. That's roughly 3.55 billion shares that are effectively locked away. It creates this severe artificial float constraint.
Right, the float is tiny relative to the company's size.
Exactly. And when you couple that scarcity with the massive technical catalyst of a NASDAQ 100 inclusion, which happened on January 20th, 2026, you introduce mandatory demand. Passive trackers like the QQQ were forced to buy billions of dollars of WMT shares to match the index. When that kind of demand hits a severely constrained float, the price gets a structural floor that just overrides skepticism.
I agree. Fighting the Waltons and the index funds is mechanically the definition of a pain trade. And the low short interest, it's somewhere between 0.6 and 1% of the float, that reflects this painful reality. It's not a sign of fundamental consensus. It's bearish capitulation. The borrow cost is just too prohibitive. But a low short interest doesn't mean the risk is gone. It just means the risk has shifted to the derivatives market. We've seen some isolated but very significant pockets of concern there.
Okay, like what?
For example, there was a huge options trade. Someone bought 3,000 puts for April 2026 with a 115 strike price. That position cost well over $1 million to open. It tells me at least one big, sophisticated player is placing a calculated bet on a sharp reversion to the mean once all this index euphoria fades and the forced buying is done. That technical floor you described is real, but it might be temporary.
I'd challenge that time frame, though. The market isn't just pricing in the technical flow. The NASDAQ inclusion is a psychological event, a grounding event. It solidifies Walmart as a growth stock that can now attract a whole new class of growth-only fund managers who probably ignored it on the NYSE. And beyond that, the market is pricing in the future operational execution that will close that valuation gap faster than you think. Specifically, it's pricing in the success of the aggressive automation drive.
All right, let's delve into that automation promise then, because that really is key to justifying the 40x multiple. How exactly does that drive earnings fast enough to support this price?
The stated goal is to get to 65% automation servicing all U.S. stores by the end of fiscal year 2026. This isn't just about efficiency, it's a structural change to the labor model. By automating processes in the stores and distribution centers, pallet building, sorting, micro-fulfillment, Walmart dramatically cuts the labor cost per unit sold by about 20%. That 20% reduction cascades directly into margin expansion. It rapidly improves their operational leverage. So the thesis is simple. The high price today suggests the market is betting heavily that these cost savings, plus the 20 to 30% growth from Connect, will cause earnings to surge over the next 18 months. And that will make today's 40x PE look a lot cheaper in retrospect.
I'm just not convinced the sum of the parts calculation works, even with a 20% labor cost reduction. You're trying to blend a high multiple ad business. Let's be generous and give Connect a 60x multiple, with a gargantuan low multiple retail base that, even when automated, might justify, a 20 or 25x multiple? The weighted average of that is still way lower than 40x. And if we look at peers, the distortion is obvious. WMT is trading way richer than Target, which is hovering around 12x, and even richer than Amazon at about 34x. You're getting close to Costco's near 50x multiple, but Costco has the protection of a strong membership fee model. That's high margin, sticky, predictable revenue. Walmart doesn't have that buffer. The market is granting a tech premium while ignoring the gravitational reality of the consumer staple sector.
But that peer comparison is faulty precisely because the quality of the earnings is different. Connect isn't just an adjacent business. It's the strategic profit engine that subsidizes the low-margin retail operation. The value isn't just in the ad dollars. It's in the data harvested from millions of customer transactions. That revenue is capital light, it's scaling fast, and it's extremely sticky. You're right, 80% of revenue still comes from goods, but 100% of those transactions generate proprietary data that can be monetized. So every single dollar of profit in 2026 is structurally better than a dollar of profit in 2016. It demands less capital investment to maintain. That's the entire difference between being a high-volume retailer and a digitally integrated omni-channel ecosystem.
That focus on the digital ecosystem brings us right to the execution risk, especially with the leadership transition. I mean, the strategy is brilliant, but we can't ignore the latent social risks here. The Macmillan era was successful, yes, but it also saw the CEO pay ratio balloon to 930 to 1 by 2024? That social disparity, paired with the aggressive push for automation, which, let's be honest, displaces human labor, creates a huge reputational fragility. If the automation rollout hits a snag, or if labor movements gain real traction, that social friction could seriously hurt sentiment at a time when the price relies on a perfection narrative.
I'd actually argue the leadership transition is a massive positive signal of continuity. The handover to John Furner on February 1st is a strategic scale-it handover, not a fix-it scenario. Furner's mandate is crystal clear: accelerate the digital transformation. His focus is on shifting Walmart from a traditional search-based platform to an agent-led ecosystem through aggressive investment in generative AI. We're talking about the major partnership with Google's Gemini, the deployment of proprietary tech like Sparky.
I'm sorry, I just don't buy that the transition is seamless in this context. Furner inherits the CEO role at the moment of absolute peak pricing. That's incredibly precarious. McMillan was a charismatic statesman, skilled at navigating complex political and social issues while pulling off this pivot. Furner's profile is distinctly more operational, and that difference really matters when your stock is trading on narrative maintenance.
But his operational rigor is exactly why he's the right choice. Look at his track record leading Sam's Club. He closed underperforming stores, he was ruthless about efficiency, and he successfully deployed customer tech like Scan & Go and BOPS. That success shows he has the digital fluency and operational rigor you need to execute this vision at scale.
It shows operational capability, yes, but executing at a 40x PE requires more than that. It demands flawless communication, and analysts have flagged documented communication failures in his past. That's a potential liability when the price depends on the narrative staying pristine. He has zero margin for error. Any hiccup in automation, any operational slip-up that causes an earnings miss could trigger a severe and totally disproportionate correction, and Furner would get the immediate, harsh blame for a fall that was probably inevitable just because he was the one holding the mantle when gravity finally asserted itself.
To sum up my side, the case really rests on the structural permanence of this transformation. The market is rewarding a strategic pivot that's evidenced by the high-margin ad business, the scarcity premium from the Walton float, and the powerful technical tailwinds of the NASDAQ inclusion. It's all secured by a clear leadership mandate under Furner to accelerate automation and AI. The stock is, in my view, fundamentally supported, and the earnings are positioned to catch up through deep operational leverage.
And my case rests on the mathematical fragility of the current price. The valuation is stretched so far beyond the company's core 4 to 5% growth rate, and it carries a huge risk of a severe derating if sentiment shifts back to staple stability. The technical factors, they're a temporary safety net, but they can't overcome the fundamental gravity of that 80% low-margin revenue base if the high-margin businesses don't scale fast enough to truly justify this exceptional 40x multiple.
It is the fascinating paradox of Walmart in 2026. You have a fortress of fundamental operational strength trading at a valuation that implies, well, fragility and zero room for error.
The price is being held up by the Walton float and the QQQ buying, but gravity is still pulling on that massive low-margin revenue pace. I guess it really leaves you to weigh whether the structural changes are enough to justify the premium, or if the math suggests the price of victory is just too high right now. There's certainly a lot more to explore here as this all unfolds.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.